You've probably heard traders talk about the market having a rhythm. Maybe you've even felt it yourself, that strange sense that certain times of year seem to push the market in one direction or another. A rally here, a sell-off there. It's almost as if the stock market has its own heartbeat, its own breathing pattern. And yet, most traders never fully explore it. They treat it like superstition or coincidence, and in doing so, they leave money and opportunities on the table. These rhythms aren't magic. They're not secret codes whispered by Wall Street insiders. They're the result of human behavior, economic realities, institutional cycles, and yes, a dash of history repeating itself. This is the hidden world of calendar patterns, the subtle, predictable flows that influence stock prices year after year. Some of these patterns are famous. Sell in May and go away, the Santa Claus rally, the January effect. But beyond the catchy headlines and market folklore lies something deeper. Statistical tendencies, seasonal shifts in liquidity, fiscal year deadlines, fund rebalancing habits, and even holiday-induced optimism or caution. These forces don't guarantee a specific outcome, but they tilt the odds. And as any seasoned trader will tell you, consistent profits come from stacking as many of those odds in your favor as possible. Understanding these patterns isn't about predicting the market with 100% certainty. No one can do that. It's about being aware of when probabilities shift, when certain setups become more likely, and when you might want to adjust your risk. It's about adding another tool to your trading arsenal, one that many overlook. Think about it. Hedge funds and large institutions absolutely account for these cycles. They plan portfolio rebalances around them. They time certain market moves to coincide with these seasonal shifts. If the big money respects the calendar, why wouldn't you? In this journey, you're going to step into that hidden rhythm. We'll explore the most important yearly cycles, understand why they happen, and see how you can incorporate them into your trading without falling into the trap of blind pattern following. Because here's the truth. The moment you treat any seasonal pattern as a guarantee, the market will remind you who's in charge. Instead, we're going to approach this like a professional. We'll break down the psychology behind each cycle. We'll talk about the risks of overfitting historical data. We'll separate the patterns worth respecting from the ones that are just market myths. And most importantly, we'll connect these cycles to the emotional and psychological traps that traders fall into when they misunderstand them. This isn't about memorizing dates. It's about seeing the market through a different lens, one that lets you recognize when seasonal psychology might be working in your favor or against you. By the end, you'll not only understand the key market cycles that repeat each year, but you'll also have a clearer sense of how to use them with discipline, patience, and a razor-sharp trading mindset. So take a deep breath, forget the noise, step away from the endless stream of hot tips and urgent alerts. You're about to discover the quiet, predictable undercurrents of the market, the kind that can give you a small but meaningful edge year after year. Chapter 1. The Invisible Clock of the Market. You wake up in the morning, glance at your charts, and the market looks ordinary. Prices are ticking up and down, news headlines flicker, talking heads are chattering. But beneath all that noise, something else is ticking. Not a stock ticker, not an earnings report. Something far older, far more predictable, and far more powerful than most traders even realize. An invisible clock. The market has a heartbeat. It doesn't show up on your chart like a moving average. It's not written into the Fed's minutes, and it's definitely not printed on the financial calendar in bright red letters. Yet, year after year, decade after decade, this silent metronome keeps time. The market breathes in optimism, exhales fear, and moves to rhythms that most traders only notice after the fact. Think about it. We've all seen it. January optimism, summer slowdowns, autumn storms, and that strange burst of cheer that often fills December's final days.
They call them seasonal patterns or calendar effects, but that's too cold, too mechanical. What they really are is a reflection of human nature itself. Every trader you've ever met, whether they admit it or not, is part of this clock. You, me, the fund manager running $10 billion, the kid day trading from his bedroom. We're all influenced by cycles in ways we can't always see. And when billions of dollars of buying and selling follow the same seasonal pulses, the effect becomes impossible to ignore. You see, markets are not just about earnings, interest rates, or GDP growth. They're about the rhythm of participation. Institutional money managers, hedge funds, pension funds, mutual funds, they don't just randomly decide when to put money to work. They operate on schedules. Many of those schedules are tied to the calendar year. Performance is measured quarterly. Bonuses are decided annually. Tax loss harvesting happens in December. Cash redeployment happens in January. And when you start to overlay all those habits onto the market's price history, the same shapes keep appearing, over and over again. But here's the trap. Most traders never learn these rhythms the right way. They hear about sell and nay and go away, and think it's some magic rule. They read about the Santa Claus rally and expect December to be a guaranteed money printing month. And then, they get blindsided when the market defies the script. That's because cycles are not rigid laws. They're tendencies. Strong tendencies, yes, but tendencies shaped by crowd psychology, liquidity flows, and big money positioning. They can bend, they can twist, they can even break when something massive hits the market, like a war, a crash, or a pandemic. Yet more often than not, they're still there, quietly guiding the ebb and flow of prices. Think of it like the tide. The tide doesn't guarantee you won't get hit by a wave out of nowhere. But if you know when the tide is coming in, you're not surprised when your feet start getting wet. The market's invisible clock works the same way. It won't predict the exact day of a rally or a crash, but it can tell you when the odds tilt in your favor and when they're quietly turning against you. And this is where trading psychology comes in. Because knowing about these cycles is not enough. You have to use them without letting them use you. If you simply buy in January because it's supposed to go up, you've fallen into the exact trap professionals use to take money from the overconfident. But if you understand the reason January often sees inflows, and you combine that knowledge with real market confirmation, you're suddenly playing on the same field as the big players. In other words, awareness gives you choice. Blindness makes you prey. Let's get brutally honest for a second. You've probably traded against these cycles without realizing it. You've probably wondered why your trades in August felt like they were slogging through molasses, why September kept handing you losses even though your setups looked perfect, why the last few days of the year sometimes felt like the market was being gently pushed higher for no logical reason. It's not magic. It's the rhythm. And here's the real kicker. Once you start seeing it, you can't unsee it. You'll spot the end-of-quarter window dressing when fund managers dump losers and showcase winners. You'll notice how volume thins out before holidays, making even small orders push prices around. You'll recognize that certain months are naturally more volatile, not because of mystical forces, but because they're loaded with catalysts, earnings, fiscal deadlines, Fed meetings. That's when the invisible clock becomes your ally instead of your enemy. Over the next chapters, we're going to pull back the curtain on these patterns one by one. We'll dissect them. We'll look at the hard data. We'll dig into the psychology that makes them work and the traps that catch traders who use them without discipline. Because here's the truth. These patterns are not some dusty historical trivia. They're alive. They're part of how markets function today. And if you're serious about mastering your trading psychology, you can't afford to ignore them. So let me ask you, Are you ready to stop trading against the rhythm and start trading with it? Because the invisible clock is ticking, and the market is about to move.
Chapter 2. Why Markets Move in Patterns. You've heard the phrase, the market has no memory. And on the surface, that's true. Prices don't rise just because they rose last year on the same date. The S&P doesn't remember what happened in May 1998 or November 2013. But traders remember. Fund managers remember. Corporate CFOs remember. And human nature never forgets. That's the key. Markets move in patterns not because of some mystical alignment of stars, but because the people who are the market keep repeating the same behaviors, year after year, generation after generation. Let's strip away the noise and look at what's really going on. 1. Institutional schedules and incentives. If you want to understand market patterns, follow the money, specifically the big money. Hedge funds, pension funds, mutual funds. They don't just throw darts at a calendar. They have rigid reporting cycles, performance targets, and investor expectations. For example, imagine you run a $5 billion fund. Your investors expect quarterly updates. If your portfolio is lagging behind in September, you might take more aggressive positions going into the fourth quarter. If you've had a stellar year, you might trim risk early to lock in your bonus. Multiply that behavior across hundreds of funds, and you get an institutional heartbeat that shows up in market prices. 2. Tax laws and fiscal calendars. Tax deadlines have a massive psychological effect on trading behavior. In the U.S., December is often a month of tax loss harvesting, where investors sell losing positions to offset capital gains. Then, in January, some of that money gets redeployed, creating what's called the January effect. It's not magic, it's just people optimizing their taxes in predictable ways. 3. Earnings seasons as market drums. Every quarter, companies report earnings, and that's not just about numbers, it's about expectation management. Analysts set the bar, companies try to clear it, and traders react. Over time, you start to notice rhythms. Volatility spikes during earnings weeks, trends accelerate or reverse based on big misses or beats, and certain sectors heat up or cool off like clockwork. It's the sound of the market's drumline. You can almost set your watch to it. 4. Human positioning to time. Humans are wired to mark time, birthdays, anniversaries, New Year's resolutions. In trading, we do the same thing. I'll start fresh in January. I just need to get through this quarter. I want to be flat before the holidays. These mental checkpoints influence buying and selling decisions en masse. When millions of participants are subconsciously syncing their actions to the same calendar cues, patterns emerge whether they intend them or not. 5. Liquidity and participation flows. Not every month feels the same in the market. In August, trading desks thin out because people are on vacation. Around major holidays, liquidity dries up, and even small trades can push prices further than usual. On the flip side, in January and September, participation tends to surge as capital is redeployed after idle periods. This is why you'll often hear traders say, "Don't fight the tape during thin markets." Thin tape behaves differently, and if you know when it's coming, you're not caught off guard. 6. Herd behavior amplifying the cycle. Patterns in the market are self-reinforcing. Once enough traders believe in them, they start to act on them. And when they act, the pattern becomes real, even if it was weak or non-existent before. For example, if enough traders believe that October is crash month, they might sell more aggressively in early October just in case,
which increases the odds of a sharp drop, which then confirms the belief for the next year. The market is a mirror. The patterns are our own reflection. 7. The role of media and narrative. Financial media loves patterns. They make great headlines. Santa Claus rally lifts stocks. Sell in May and go away works again. Every time the media reinforces a seasonal effect, it sinks deeper into the collective consciousness of traders and investors. You might not think a headline changes behavior, but when you read about the January effect 10 times in 2 weeks, it plants a seed. And in trading, seeds grow into trades, trades grow into moves, and moves grow into patterns. So here's the truth you need to absorb. Calendar patterns aren't guaranteed. They're footprints. They're the collective imprint of human psychology and institutional structure stamped into the market year after year. The danger? Believing they're guaranteed. That's when you get lazy, complacent, and blindsided by an exception year. The opportunity? Understanding why they exist and using that knowledge as a contextual edge, not as a trading trigger on its own. Think of them as background music. You wouldn't dance the same way to a slow waltz as you would to a fast drum beat. Likewise, you shouldn't trade the same way in August's sleepy low-volume drift as you do during October's high-volatility storms. The music changes. Your moves should too. Over the next chapters, we'll get granular. We'll walk through the most well-known and misunderstood seasonal effects. I'll show you the data, the psychology, and the traps. But more importantly, I'll show you how to keep your emotions in check when the calendar tempts you into lazy thinking. Because the professional's edge isn't just knowing the pattern, it's knowing when to trust it and when to ignore it entirely. So take a breath. The invisible clock is still ticking. And next, we step into the first major chime of the market year.
Chapter 3. The January Effect. It's the first trading day of the year. The champagne glasses are still sitting in the sink. Your resolutions are fresh, your desk is clean, and there's that strange feeling of a reset in the air. You're not the only one who feels it. All across the market, traders and portfolio managers are coming back from the holidays with a mental, fresh start. Capital that sat idle in December is suddenly in motion. Orders are queued up. Ideas that were shelved in November are being dusted off. And historically, something interesting tends to happen. Small-cap stocks outperform, prices drift higher, and optimism fills the tape. This is the January effect. Where it comes from. The textbook explanation goes like this. In December, many investors sell losing positions to lock in tax losses. They use those losses to offset gains from winners, reducing their tax bill. Once the new year begins, some of that capital flows back into the very stocks that were sold, often small-cap, lower liquidity names, pushing prices upward in early January. But that's just the structural side. There's a psychological side, too. January is a mental year one. Performance records start at 0. Bonuses from last year are locked in, and this year's targets haven't yet been missed. The fear of loss is quieter. The hunger for new gains is louder. You can feel it in the market's body language. Subscribe this channel for daily trading psychology mindset video. The psychology behind the pattern. This isn't just about taxes. It's about optimism and the human brain's obsession with starting fresh. Think about New Year's resolutions. Gyms fill up in January. Diet books fly off the shelves. People feel like they can reinvent themselves because the calendar flipped. Traders are no different. This is my year, you tell yourself. This time I'll stick to the plan. That emotional optimism translates into a willingness to put on trades more aggressively. And when enough traders are doing the same thing, prices respond. The trap of the January effect. Here's where most traders blow it. They assume January will always rally. They read some article saying, since 1950, the S&P has risen X% in January 70% of the time, and they treat it like gospel.
But here's the reality. The January effect is a tendency, not a rule. There are plenty of years where January has been weak or even downright ugly. Sometimes it's because December didn't have much tax loss selling to begin with. Sometimes macro events hit early in the year. Sometimes sentiment is already overheated and the first sign of bad news triggers a sell-off. If you blindly buy because it's January, you're not trading, you're gambling with a seasonal crutch. The professional approach. So how do the pros actually use this pattern? They don't just buy on January 2nd and hope. They track December's behavior. Was there heavy selling in small caps or underperformers? Was liquidity thin? Was sentiment sour? If so, they might anticipate a stronger bounce. They also watch confirmation. Is breadth improving in the first week of January? Are small caps outperforming large caps? Are new highs expanding? Those are signs the January effect might be in play. And, here's the big one, they use it as context, not a trigger. If they were already leaning bullish based on technicals and macro conditions, January's seasonal tailwind gives them more confidence to press trades. If the market is breaking down technically, they don't ignore the warning signs just because January is supposed to go up. January's first 5 days. There's an old Wall Street saying, as goes the first 5 days, so goes the year. It's not perfect, but there's data showing a positive start to January often correlates with a positive year overall. Why? Because the optimism that drives early year buying can create momentum. Funds that start in the green feel less pressure to chase performance in panic later on. They can be patient and selective, which helps maintain market stability. But remember, correlation is not causation. Just because a good January has often led to a good year doesn't mean the calendar magically controls the outcome. Sometimes the market rallies in January and then tanks in February. The point is to use it as one piece of the puzzle. How you use it without getting burned. If you want to integrate the January effect into your own trading psychology, here's your checklist. Review December's action. Was there heavy selling in small caps or underperformers? Check liquidity and participation. Are volumes rising in early January? Look for confirmation in breadth. Is the advanced decline line strong? Are sectors rotating in bullish ways? Avoid blind faith. Treat January as a tailwind, not a guarantee. And stay nimble. If price action fails quickly, respect it. The market doesn't care about your calendar theory. Why this matters for psychology. If you start the year with a win because you respected the pattern and waited for confirmation, your mindset gets a boost. Confidence rises. You're calmer, sharper, more willing to follow your plan. But if you get burned in January because you bought blindly and refused to adapt, your psychology can spiral. You start thinking, I'm already behind for the year, and that can push you into revenge trading before February even arrives. The January effect isn't just a market quirk. It's a mental inflection point. Handle it well, and you begin the year with focus. Handle it poorly, and you're playing catch-up for months. So when you log in on that first week of January, remember, the invisible clock is ringing in a fresh cycle. It's not telling you what to do. It's telling you when to pay attention. Chapter 4. Earnings Seasons and Mid-Quarter Drifts. The calendar flips, but not every market rhythm comes from the seasons. Some come from the corporate clock. 4 times a year, like clockwork, the market enters one of its most intense cycles, earnings season. It's when companies open their books and show the world how they've performed. And for traders, it's like a giant spotlight suddenly hitting the stage. The structure of earnings season. In the U.S., earnings reports cluster into 4 main windows: January-February, Q4 results from the previous year; April-May, Q1 results; July-August, Q2 results; October-November, Q3 results. Each of these seasons starts with the big banks. The financial sector often kicks off earnings, and because banks touch so many corners of the economy, their results set the tone. After that, waves of reports from tech, industrials, consumer companies, and others roll through. By the end of the season, thousands of companies have reported, and the market has repriced accordingly. Why earnings move the market? Earnings aren't just numbers, they're expectations versus reality. The market constantly prices in what it thinks will happen. Earnings season is when reality walks in the door. If expectations were too low, you get upside surprises. Stocks gap up, sectors rally, indexes climb. If expectations were too high, you get disappointment, gaps down, sector weakness, broad market drags. Here's the thing, expectations themselves often follow predictable patterns. Analysts tend to lower estimates as earnings approach, making it easier for companies to beat. That's why you'll often hear about earnings beats that aren't as impressive as they sound. The bar was lowered ahead of time. Mid-quarter drift. There's another subtle pattern that hides in plain sight, the post-earnings drift. When a company reports strong earnings and guidance, the good news doesn't always get fully priced in immediately. The stock can drift higher for weeks afterward as more traders and investors notice and buy in. The reverse happens with bad reports. A weak quarter can lead to a slow bleed lower. This drift isn't mystical, it's human. Big funds can't just buy or sell their full position in one day without moving the price too much, so they scale in or out over time, creating that slow follow-through. The psychology of earnings season. Earnings season stirs up some of the strongest emotions you'll feel as a trader: excitement, anxiety, FOMO, regret. When a stock gaps 12% overnight because of a blowout quarter, part of you thinks, I should have bought before earnings. When another stock drops 15% on a miss, you think, I'm glad I stayed out, but maybe I could have shorted. This is where discipline gets tested, because here's the trap. The temptation to gamble on earnings is massive, and most traders, if they're honest, have blown up a position or two chasing an earnings gamble that went the wrong way. Professionals approach it differently. They know that earnings gaps can be unpredictable, even when the setup looks perfect. So they wait. They let the dust settle. They trade the reaction, not the prediction. Seasonal tendencies around earnings. Earnings seasons themselves create ripple effects in the broader market. January, February, often strong because Q4 results can benefit from holiday sales and optimism about the new year, but also volatile if guidance for the new year is weak. April, May, often calmer as Q1 results set the tone without the holiday distortions. July, August, can be choppy due to thin summer liquidity colliding with earnings volatility. October, November, one of the most closely watched seasons, as Q3 results influence positioning ahead of year-end. The mid-quarter months, March, June, September, and December, often see quieter, more directional moves as the market digests the last earnings season and positions for the next. How to trade with the corporate clock. If you understand the rhythm of earnings season, you can time sector trades, know when certain industries report and how that might influence ETFs or indexes. Play sympathy moves. When a big company reports, competitors often move in the same direction. Avoid landmines. Steer clear of holding large positions into earnings unless your strategy is built for it. Catch the drift. Ride the slow post-earnings trend once the initial chaos fades. The pros don't just know when earnings are, they know when not to fight the tape during earnings weeks. Liquidity, volatility, and sentiment all shift in these windows. Earnings and your mindset. One of the most dangerous mental traps is thinking, I'll just make it all back with one earnings win. That's revenge trading disguised as opportunity. A healthier mindset is to view earnings season as a series of opportunities, some in the moment, some in the aftermath. You don't have to trade every earnings name. You don't have to catch every gap. You just have to find the setups that align with your process. Because here's the truth. Earnings season isn't going anywhere. It's part of the market's permanent heartbeat. If you miss a setup this quarter, there's another one coming in 90 days. Patience is a weapon. So, as the corporate clock ticks and the market lights up with green and red flashes, remember this. Earnings season is not a slot machine. It's a recurring cycle. Learn to read it. Learn to time it. Learn to wait for it. And you'll find yourself surfing one of the most reliable rhythms in the market year after year. Chapter 5. The Sell in May Phenomenon. There's an old Wall Street saying that refuses to die. Sell in May and go away. It sounds almost too simple, like a lazy rhyme someone came up with at a bar after the market closed. And yet, it's one of the most discussed, most tested, and most argued over seasonal patterns in history. The basic idea? Historically, the stock market's strongest performance has tended to occur from November through April. The May through October stretch, in contrast, has often produced weaker returns. But why? And more importantly, should you actually listen to it? The historical roots. This pattern isn't new. In fact, its earliest references come from London's financial district centuries ago, where traders supposedly said, "Sell in May and go away, and come back on St. Leger's Day," a nod to the horse racing season that kept the wealthy distracted until autumn. In the U.S., data going back decades shows that, on average, the market's returns from May to October have indeed lagged behind the November to April period. But averages can be deceptive. There have been years when the May to October stretch produced monster rallies, and there have been winters that delivered nothing but pain. Why the pattern exists? A few explanations get thrown around. Summer slowdown? Trading volumes tend to drop in the summer months as both retail and institutional players take vacations. Lower participation can mean weaker momentum. Earnings and guidance gaps. The May to October stretch doesn't align with the big end-of-the-year spending season or the first quarter optimism, leaving fewer catalysts. Institutional positioning. Many funds make big allocation moves early in the year, then coast during the middle months unless something big changes. Psychology and risk appetite. Investors often grow cautious heading into the summer, wary of unexpected events during thinner liquidity periods. But here's the truth. No one can point to a single cause. It's more likely a mix of factors that over time have created a statistical tilt. The danger of blind obedience. Here's where traders get into trouble. They treat sell in May as a hard rule instead of a tendency. They hear the stats, see a few charts, and decide that May 1st is a magical exit date. They dump positions, sit out for months, and sometimes watch the market rally without them. Other times they short aggressively in early summer, expecting a pullback, only to get squeezed by a June breakout. The market doesn't owe you a seasonal pattern just because history says it should happen. How professionals use it. Pros don't just sell on May 1st because of an old rhyme. Instead, they watch the tape. Is market breadth weakening? Are leading sectors stalling? Check macro context. Is the Fed tightening? Are earnings forecasts slipping? They monitor sentiment. Is optimism stretched thin? Are complacency levels high? If the market is showing technical weakness going into May, the seasonal tendency becomes an extra layer of caution. If the market is roaring higher with strong breadth, they might stay long, but with tighter risk controls. Psychology in the summer months. The summer lull is as much mental as it is structural. When liquidity thins, traders feel every move more intensely. A 1% drop feels heavier because there's less activity to offset it. A low-volume rally feels fragile, easy to break. For retail traders, the slower summer can be dangerous. Boredom leads to overtrading, overtrading leads to mistakes, and mistakes in thin liquidity can snowball fast. This is why seasoned traders often reduce position size in the summer, focus only on the cleanest setups, or take deliberate breaks to avoid forcing trades. May to October is not always bearish. History is full of exceptions. 2009, the market was in a strong post-crash recovery, and the May to October stretch produced massive gains. 2020, Pandemic volatility and stimulus kept markets hot well through the summer. If you'd blindly sold in May in those years, you would have missed significant moves. This is why context matters more than the rhyme. The sell in May period can be weak, but only when the underlying market conditions align with the tendency. A smarter way to play it. Treat it as a probability shift, not as a signal. Use it to tilt your bias slightly, not dictate your trades. Layer it with technicals. Watch key support and resistance levels. Seasonal weakness is only meaningful if the chart confirms. Adjust your risk. Consider smaller positions or quicker profit-taking during historically weaker months. Stay selective. Fewer trades, higher quality. The mental edge. Knowing that summer months can be slower helps you manage expectations. If you're not expecting fireworks, you're less likely to force trades. You can use the quieter months to refine your process, study, and prepare for the historically stronger end-of-the-year stretch. Ironically, that's part of what makes sell in May valuable, not as a trading trigger, but as a mindset shift. It reminds you that the market moves in seasons, and not every season is built for aggressive play. So when May comes and you hear that old rhyme again, remember, it's not a prophecy, it's a caution, one of many whispers from the market's invisible clock. Conclusion. By now, you've walked through the calendar of the market, the subtle waves, the repeating patterns, the predictable emotional shifts that happen as the year unfolds. You've seen how human behavior, institutional mechanics, and economic timing combine to create tendencies that many traders ignore. And you've learned something even more important, that patterns themselves aren't the magic. Your discipline in using them is. The truth is, the market doesn't care if it's January or December. It doesn't care about catchy phrases or old Wall Street sayings. What the market does care about is the flow of money, the timing of decisions, and the way traders collectively react to certain points in the year. Calendar cycles don't create certainty, they create opportunity. And opportunity only turns into profit when you handle it with skill. You now know that the January effect isn't just about small-cap rallies, that sell in May isn't a commandment, but a reflection of shifting liquidity and investor sentiment, that the Santa Claus rally is as much about psychology and low-volume optimism as it is about hard numbers. And most importantly, you know that every one of these patterns has exceptions, years when they fail, moments when they invert, times when following them blindly could lead you straight into a loss. This awareness is your edge, not because it guarantees you'll win, but because it helps you avoid the unnecessary losses that come from ignorance. Most traders lose money not because they can't predict the market, no one can, but because they ignore the hidden forces shaping it. You're no longer in that category. The challenge now is to integrate this knowledge without becoming overconfident. The market loves to punish certainty. If you convince yourself that a pattern must happen, you'll stop managing risk. You'll double down when you should step aside. And that's when a simple seasonal shift turns into a portfolio disaster. Instead, approach these cycles as probabilities. Think like a chess player, not a gambler. If the board looks favorable, you make the move, but you never forget your opponent can still surprise you. That balance of confidence and humility is what separates traders who survive from those who blow up. So as you move forward, remember, patterns are guides, not guarantees. Risk management matters more than the pattern itself. The market's seasonal rhythm is powerful, but so is your ability to stay patient and selective. You now have a map that most traders never study, but a map only matters if you use it wisely. The cycles will keep turning, the market's heartbeat will keep pulsing, and every year there will be traders caught off guard by moves they could have anticipated. Make sure you're not one of them. Trade with awareness, trade with discipline, and when the market's rhythm aligns with your plan, step forward with confidence, knowing you're moving with the current, not against it.